How is this market different? We've got heavy distribution days on the market, just as many other major peaks have done in the past. And now we have the rumor of interest rates. Can the rumor of interest rates be enough to tumble the top of the mountain as it has done previously? Plus, we've also got inflation. It's here. It's got constrained supply to the point of not being available. And we've got somebody to guide us through, which is Gary Glover from Novus Capital. Good morning, Gary. How are you?
Yeah, great, Chris. It's all happening, isn't it, really, in the market?
Oh, there is. There's a lot. And in your report this week, you've mentioned a few things, but what's not going to show on screen is your commentary around the other factors in the economic side of things that are happening. And you noted a bit of a note there on inflation, and I wouldn't mind bringing into that those of us who are in Australia and going to shops and paying for things, we've definitely got higher prices, and we've got aftermarket sales of cars that are reportedly between 50 and 150% over the recommended retail price. Houses selling for 20% over the high end of their target ranges. How is it that this can't be inflation? Like, is it oil that's going to be the one that the central banks blame when they eat their humble pie and this comes about, or is this just really transitory? What's that conversation look like to you, Gary?
Yeah, I mean, look, I think I sort of covered sort of 5 key concerns there. I've sort of been talking to clients this week, and the first one is inflation. I mean, whether it's transitory or not, it is here. So, look, oil price, gas prices, just look what's happening around the world, all stock prices, property prices, all the asset class, the costs of, shipping stuff there. So transitory or not, it is here. With those effects here, that so far they've lasted a lot longer than all the central banks who said they were transitory, said they would. So whether they do abate or not, we've still got some headwinds there. So whether that is short term or long term, we don't know. All we know is it's lasting a lot longer than everyone's thinking so far, and that's got to be a bit of a concern. I think the second biggest thing there is what's happening now is the reduced sort of stimulus and the reduced handouts. I mean, we've got tapering coming on in November here for the US and the Fed there, and all the handouts. Obviously, a lot of the governments have been giving, a lot of handouts to the unemployed and to businesses there. So that's all going to stop here now. So that's all those sort of all that sort of stimulus is going to, as we open up here, that's all going to end. So kind of finally going to see who's made it and who's not. So there's a lot of businesses that probably won't succeed here or are on the ropes. We just haven't we just don't know who they are because of the all these handouts there. But yeah, they'll be interesting to sort of see what happens there. I think there's got to be some sort of some damage there, which we don't know about yet. Interest rates, I mean, look, the Fed's already indicated they're going to lift rates as well. That's probably the third concern I see. NZ, New Zealand, obviously increased rates here recently. The RBA is kind of on their lonesome, sort of. I don't know whether the RBA is going to be eating humble pie, in a year or two, but saying, locking us into this view of no rates till 24, it's a very close-minded view. It's just doesn't make sense to me because we don't know what's going to happen here. I mean, inflation's already lasted longer than everyone's thought. So there's a few concerns there. You got places like Turkey with inflation at 16%. So some of these other regions around the world have already quite a few central banks. If you go and sort of Google how many central banks have lifted rates in the last 6 months, it's a lot more than you think. So quite a few central banks have already lifted rates here already. And then I guess the fourth worry I see is increased taxes as well. So at some point, all this stimulus that the governments have all around the world thrown in here, we've got to pay it back at some stage. So you can sort of see Biden's already positioning sort of tax. So who's going to get taxed the most? Obviously the richest and the wealthiest, and obviously those firms that are making the most amount of money. So we've already seen the Googles and Apples and those guys. Biden's already positioning that to they're going to be paying a lot more tax here. So that that's a concern for corporates as well. And I think just the general economy here as well as in terms of that sort of stimulus there. We've seen with the lockdowns that's there's been some winners and there's been some losers there. So when we come out of lockdown, we might have some different winners and different losers. So not everyone can win. I think at the moment everyone's got their sort of rose-eyed glasses on, and looking like everything's going to bounce back. The economy is going to bounce back here, but some, as a result of this lockdowns here, there will be some winners from that, and there will be some losers as well. I don't think no one's looking at who's going to lose from lockdown. There's got to, unfortunately, there have to be some losers. So I just see a few headwinds there. And look, each one of those on their own might just have a little impact on the earnings for corporates and for obviously money in the system. But if all those things persisted and all those things were a lot more severe than we're allowing for, then altogether that could have quite a decent impact on earnings moving forward here for the next year. So I can just see that the gains in the equities markets are going to be a lot skinnier. They're going to be a lot tougher to come by in the next 1 or 2 years. So just got to be cautious here, because it's just going to be a tougher environment. It's funny, I saw something yesterday on Ausbiz, sort of the startup there. They're talking about startups that have now got like $1 billion market cap. So what they call it, the unicorn status. So I think we had like one in 2018. We had 2 or 3 in 19. I think we had 4 in 20. We've had 19 this year. So these little startups that have now got $1 billion market cap. So pretty amazing. So, but it does sort of highlight where we are in the cycle here. So, but let's have a look at these charts, Chris?
Well, that's a good point to segue into, because you said that the central banks, the transitory inflation is going on a lot longer than they'd expected. One market that really signifies going on a lot longer than expected is the NASDAQ. And you've put here that there's a bit of a bearish break and bearish divergence. So what's the bearish break and divergence, and what does that mean on the chart side of things? Yeah,
so look, in a nutshell there, we've got, we've broken the upward trend line here. So this third ascending trend line, even the second support line, we've now broken that as well. So we've broken a really important trend line. We've got all our indicators are all highlighting major divergence there. So I'm not a big divergence sort of guy, but when you sort of see, weekly and massive divergence like this, like, probably two, what I call almost like triple divergence, sort of going up for a second or third timing divergence, I do consider that really significant. And the third thing there, we've seen volume. So far, the down days, we've seen some pretty heavy selling in there. So up into this stage, we were looking for some sort of signs of selling into this sort of rally here, and that hasn't really come. We've had a few days, but not, in the last couple of weeks, we've got a major cluster of heavy volume sort of down days here. So the volume's getting a lot more aggressive on the down days. So that's a sign of distribution for me. So those 3 signs are all pretty bearish on their own. So together, pretty negative for mine. And put in the mix here that we've got this vertical trend here, which is broken as well. Mate, that's like it's the it's the Quinella of sort of of bearish of signs here. So I think this looks pretty bearish. So just if we're looking for individual bearish signs here, we've got 4 crackers here at the moment. So I just think you got to be very very cautious here. I think the market looks like it's tipping over here. It's all the signs of a larger sell-off to come.
So that's on the NASDAQ. What about the S&P500? Because you've still got a bit of a bearish tinge there. Is that still at the markets as well?
Yeah, it's the same thing there. So obviously we've got our big sort of rising wedge there. We've got our sort of our key Fibonacci levels. If we go back to that first sort of range there on a weekly chart as well. So I think it just went slightly above the 423 level, but yeah, big important level. Also doubled the range off the sort of COVID sort of pre-COVID high, that sort of sell off there, and doubled that range to high. So we got a really important level up there. So so again, we've got distribution as well. So looks like it's all the signs of a good top in place here. If we're to pull back, I've often highlight this. If we look at trends there, when they pull back, they come back and sit on top of the previous high. That's a normal trend. So just a normal pullback for the S&P 500. We bring it back to the old high, which is pretty significant. It's 3,400. So it's a fairly sizable move here. That's just a normal correction, Chris. So that's
A
what
healthy
we got.
correction, is it?
Yeah, that's more than the other correction. That's a lot more than that. A lot of guys saying, "Oh, we're only going to get a 8 or 10% or 12% correction. We're due for a small correction." And I think one of the viewers there asked a question there last week. Is there examples of sort of where you see these vertical trends where they don't have big corrections? Is there some examples there? I've asked a few times there for someone to send me some because I've never seen them. I saw one an equity there, which I think was CSL, and it had a made this sort of 3 ascending trend lines twice there. The first one had a massive correction, and the second one only come back about 38% of the weekly range. So it had a decent correction, but it wasn't massive compared to other vertical markets. So from my experience, these vertical trends, most of them have big corrections, and the ones that don't, they still have pretty decent corrections. They have at least a healthy correction there. So I can't see anything but a healthy correction. I cannot see a small correction here. I can't see how we're going to have a small control. If you look at all the markets around the world, they're all moving quick. You got iron ore is up quick and it's down quick, and lumber was up hard and fast and it's down quick. It's just everything's moving fast. Nothing's moving in slow motion. Everything's moving very, very quickly and quite dramatically. So can't see anything but that occurring. Yeah.
Well, with that, they're the US markets and definitely moving hard and fast. When we look at the Australian market, you can kind of see that it's already been in that decline, and the 2 red lines that you've drawn on the chart, we're definitely outside of that. So have we already sort of stepped into more of a bearish phase, or what does it tell you what's happening on the Aussie?
Yeah, so we have sort of have led here a little bit. We're probably one of the early indices to sort of break down. And yeah, so look, I would expect at least a quarter of the range as a minimum pullback there, which takes us back to that old 2007 high. But look, again, we've got the same sort of ascending sort of wedge there. We've sort of broken below that. There's been pretty heavy selling. We've definitely, the volume is up. So we saw volume at the low, we've seen volume at the high here. Signs of distribution there. So I think we can see a larger correction there. So I still think our market will hold up better than other markets, but still, if you go through the top 50, look at the earnings, look at the multiples they're trading on. They're significantly higher than historical numbers. So people are making excuses as to why they're trading on big multiples. But yeah, you can go back and look at the top 50 stocks there, and look at a 10-year average of where the multiples are. The big businesses that don't change that much. Multiples are trading at, most of them are trading significantly higher than they have done in the prior decade. So low interest rates or not, that moves the needle a little bit, but these valuations are still pretty high.
Well, looking at the high valuations, in some areas have been left behind. So then casts the question to be, are there any actually opportunities in the market? And you've highlighted the AGL chart, which has been definitely on a downward trajectory, but you've also highlighted a lot of volume happening throughout the month of September this year. So what's AGL looking to you? Is it an opportunity or just something that you're highlighting that's countered the market?
Yeah, look, every time I think we saw 22.5% of the register change hands in the 2 weeks. So basically that sort of that week of the low and the week after the low there. So that's, when I see that type of character take place, that's a change in character for the stock. And it's almost almost exhaustive in nature, that sort of that low there. So just tells us that, we should be on alert to a change in character and possibly a change in trend here. So seeing big volume here, which is interesting. We're now actually sort of rallied and gone to a first new sort of higher low, which is kind of interesting because we haven't seen too many of those. So we're sort of seeing a couple of signs there that are kind of positive for AGL. So what we really want to be moving above that upper trend line. So that's probably the big resistance there, because we have been in this downtrend for quite some time here. So it really does need to move above that old sort of overhead trend line. So a couple of character changes there, which is kind of positive, but But yeah, we sort of probably, if we can break outside that range, that'll be even more constructive. So yeah, so we've just got a couple of positive signs there that there might be a change of foot here, but we still need to see a bit more from it. But yeah, it's looking interesting for sure.
Well, one that's gone from good to great to bad to not so bad is iron ore, with that rally's been nothing short of phenomenal and really helped the Australian federal budget and the fiscal side of things. BHP you've highlighted, and you've got some percentage ranges here. Is that Fibonacci's, and you got 1, 2, 3, 4. So what's BHP telling you from a trading perspective?
Yeah, so look, we've just got a big fib level there. Obviously, it's on the weekly chart there. So since 2020 low to the current high there, it's a pretty decent range there, 24 to 54, so $30 range there. So that's what we've sort of climbed here in the last sort of 12 15 months there. So pretty bullish move there, but it's a big decline too for 8 or 9 weeks, and we've basically come back sort of more than 60% of that range. So it's pretty significant. So I just sort of know that normally if this is like a 5-wave decline off the high, which it looks like it's pretty impulsive there, there's normally like a B wave in between before we get another leg down. So I think there might be another leg down here, but historically we normally see a bit of a bounce from one of the key fibs. And I just think we probably sort of see it here. So we're already seeing sort of signs the last few days that we're breaking up here. But yeah, these B waves, sometimes they can meander around, but other times they can be sort of short and sharp here. So I just think this might be a bit of a B wave in here. I think we might sort of see a bounce back up to 42, maybe even 44. So yeah, I just think it looks the iron ore price is sort of halved there. So I think they've probably overdone these for now here. But yeah, I think we'll just see a bit of a bounce in some of these stocks here.
Well, if the iron ore price is halved and we're looking at iron ore and trading it, we can't go past Fortescue Metals. And you've also put that chart in there. So FMG, you've got different kind of charts here. So some different other red lines. And are you still looking at the fib levels? Because is that showing us 50% of the range that it's dropped on this chart?
Yeah, it just dropped below there. It's looking at different levels. So I think if you go back and look at a monthly there, which would be even further back there, I think it actually might have come back to pretty close to 50 as well there. But this is just looking at I think maybe the last 4 or 5 years. But I'm probably more looking at the price action here, just as a nice sort of, it looks like there's a nice clear 5-wave structure in there. And the last sort of, the last couple of days here, we've sort of gone, it's taken a bit longer on this leg down. The volume sort of dried up, and then we've seen heavy volume at the low here. So like a little false break here. So we've sort of gone to a new low and then recovered. So we had a couple of attempts there. So just showing signs of making a little false break here. So again, looking for a little B wave here. I just was expecting this to be a bit of a counter move in this downtrend, but I just kept a really tight stop on it. And I think, if we're risking say 30 cents and if we can rally $3, that's a sort of 10 for 1 risk reward. That's not bad. I don't mind. I don't mind being wrong if I lose a little bit and make a lot. So so it just looks pretty interesting, the price action there. But I just know that typically we see some sort of counter move in these sort of stocks that get sort of hit here. So not sure it's over for Fortescue. I think there might be another leg down, but you'd normally sort of see something in between, and the B waves can be pretty sharp if history is any guide.
Well, if we're looking at that B wave, it is worth noting that as we're recording right now, the share price hasn't really rallied from those lows when you were buying for clients. So obviously this is a report that you've written a few days ago. So if people want to keep in contact with actually when you're putting the trades on, that's something that you're doing for your clients throughout the trading days, isn't it?
That's right. Yes, I just I send out live alerts, and then if clients are pretty keen on this sort of stuff. This one here is probably more shorter term. This is more of a counter move, so it's not sort of one that I was doing for long-term portfolios, but more sort of shorter term sort of trading portfolios. I thought this, the risk was, you could easily sort of get 9 to 10 to 1 in here. I end up giving myself a little bit more room there, but even around 8 to 1, risk reward is a good, that's a nice little trade there, in my opinion. So, because if we're wrong, we don't risk too much, and if we're right here, we get a nice return. So you only have to get a few of those right, and they pay for themselves.
And they're great trades to have. And if we move that lens back to more of a macro and what were you talking about at the start with inflation, the conversation for inflation normally includes gold. And this is one that you've also traded as well, this gold thematic, starting off with Northern Star. What's that chart pointing to you?
Yeah, so it looks like we've got a bit of a false break here. So it's got a history of sort of making these sort of double bottoms. I've always loved the false breaks here. So yeah, I was sort of saying to you earlier, Chris, I missed the one on Silver Lake actually. Came down and made a marginal new low and then reversed pretty sharply on big volume. It was just a perfect false break sort of signal, and then it took off here. So Northern Star's sort of done sort of something similar here. I like to sort of see it finish above the body. So weekly close above the body there would be pretty bullish for mine. So but that looks pretty interesting as well. Just gold's, obviously viewed as a bit of inflationary hedge. I'm just sort of liking it because gold's been out of favour here and come all the way back. And this market has sort of shown here in the last year that, the commodities of, one gets hot, the other one cools off, and then things sort of shift around, quite a bit there. So I just think you've got to be looking for the commodity which is sort of out of favour, the one that's sort of bottoming and trading up here, not chasing the ones that are the hottest here. So, yeah, I mean, everyone's chasing sort of energy now. We've probably had a pretty decent run. Probably, if I was long energy here, I'd be tightening up my stops here big time. So might go slightly higher here, but I'm probably potentially might be getting near the end of the move here. And yeah, so again, that's sort of classic buy the rumor sell. In fact, as the world opens up, that should be when sort of oil's almost sort of topping as well. So just the opposite of sort of almost the opposite of logic, you might say.
I mean, that's something you looked at last week in the Spanish. Yeah,
it's a travel. Yeah, it's like we'll just think of the travel stocks. Travel stocks have basically traded up here into all these highs here as the economy opens up. And what's happened the last few days? They've all started to sell off here. If you look at WebJet, I looked at WebJet there. I think I sort of posted this actually on the tweet there, but market cap now is about 2.6 billion. I think it was 1.6, 1.7 billion at the top of before COVID. So there's a lot more shares on issue now than there was sort of pre-COVID, and they haven't really sold a ticket for a couple of years here now. So I know those businesses will turn around. A lot of people say they'll be stronger because some of the smaller businesses will decline there. I agree with that, but it's going to take a couple of years. So the way I look at it now is that we're already pricing in the next 2 years of growth right now for a lot of these travel stocks. So I think Flight Centre was not quite as bad. It was when I looked, they haven't quite issued as many shares as WebJet. So I think 24.50 might have been the same as 44 in 2019. So in terms of market cap, so maybe some of the others might have a slightly more room there, but still painting still looking pretty far ahead here. With those valuations where they are. So I just typically find that sort of stocks find highs in the good news, not the other way around.
Yeah, so it's hard to say that the companies are 50% better off than what they were going into COVID, having raised all that capital. But if they are, then that would spark that there's a lot of inflation, and that would move us back to those gold stocks that you're looking at, which is you're saying they're out of favor, and that's the time to look for them when they're round in the bottom and creating an opportunity. Are you seeing one in Regis Resources RRL?
Yeah. So I think this is again we're starting to sort of see this sort of bottom sort of round off here. So starting to lose its downward momentum, and then we've seen the last month there, last 6 weeks, I've seen big volume there. So that looks sort of like accumulation type volume. We just saw a bit of a I guess a bullish reversal sign there last week, and a bit of follow through. So just sort of breaking above last week's high after that reversal is a encouraging sign. And so still got a long way to go here to get ourselves out of the woods there, but just encouraging signs. Yeah, I think there's a reasonable play in here. I think this inflation gets some legs here, which it seems to be at the moment. Even the bond yields are moving higher as well. But yeah, this trade could get some legs here. So yeah, they're out of favour, just starting to look quite good. Quite a few of the stocks are reversing. There's some good signs there. So yeah, but got to use risk management there. I've seen plenty of markets there where everyone gets dials up on gold because they think the market's going to correct here, and then what happens is gold stocks end up sort of rallying initially with the market declining, and then eventually the gold stocks get dragged down with the rest of the market as well. So don't be under any illusion that they can't come off if the market's getting a bit bearish. So they can. I've seen it before. So just make sure you apply some good risk management principles across the board.
Yeah, because when the markets get belted, the margin calls go across the whole portfolio. They don't just stick to the bad stocks. So when we're looking at industrials, or going further afield from the commodities, you've raised Invocare as something that's pulled back to previous highs on light volume. So you're talking about companies being out of favour. They're working through a bit of a bottoming process, a basing pattern, and then breaking out of it. Could Invocare be one of those companies?
Yeah, I think it could be. Yeah, I think this is kind of in that sort of reopening sort of play there in a way. Obviously, it's been a pretty, I guess, negative period for the funeral operators there, and obviously, because we're sort of social distance sort of and locked down pretty well in Australia here. Obviously, death rate is pretty low, and then because of the lockdowns, the gatherings have been a lot smaller as well. So just the sort of the normal size sort of service would have been reduced. So that's sort of been hit on both fronts there. So I think once we open up here, I expect sort of things to go back to a more normal sort of death rate, in terms of previous flus, things like that. And also I think more importantly is the service levels. More people will be allowed to go to these services there, so people will be paying for the more elaborate sort of services. So I just think this one's got some upside potential here longer term. It's been sort of hanging on, it's been sort of going sideways here for a couple of years there in those sort of negative period here. And technically I just see with a few high lows in there, the pullbacks, lighter volume. I was just looking for it to maybe just to pierce down here a little bit, which I think it's done today, which is good. So if it can kind of reverse here off this low here, it'll be interesting. But yeah, just want to sort of see it hold above that previous high there, but it's looking encouraging. Yeah.
And the last stock that we look at before we go to a throwback from the late 80s, we've got Harvey Norman, the chart that you've put in here. You've got large ABC correction on top of key support or the old high. We can definitely see that old high just before we went into the COVID meltdown that quickly happened, the downward spiral. Where we are now, we're sitting back on top of that. So is this threatening for a sell, or is this a potential buy?
Yeah, so we can hold here, then it's a potential sort of support here. I looked at the numbers on this. It's actually like the PE and yield there is pretty high at the moment, actually. I mean, sort of the PE is pretty low and the yield's high. I know they can sort of shift there. Obviously, everyone's expecting things to taper off. So I do expect Harvey Norman results to taper off there. I think everyone's got sort of lower sort of multiples moving forward here. But still think this business is going to be in a better position moving forward, like a lot of the big retailers are. They've been pretty predominant here. And I think it's going to take a little while for some of these smaller retailers to sort of get back on their feet. I just think some of them, I'm worried whether some will survive. So I just think the bigger boys will have a bit of a leg up here for a bit longer. So, but yeah, this is come back in 3 waves here, but sort of holds here. Looks pretty good down. I notice it goes ex-dividend next week as well. Pretty nice divvy. But yeah, you just want to sort of hold this level here for mine as well. But it does looks reasonably priced in a market which I think is pretty pricey. So and technically looks okay as well. And
now it's time for the throwback in the 80s. You've got a tweet that caught your eye this week. So
that's right.
A bit of self-explanatory on the picture, but can you talk us through for a bit of context?
Yeah, I've got to give Callum Thomas a bit of a rap here. He does sort of put some interesting stuff out on Twitter. He's got he's worth following there if you don't follow him. It was just sort of interesting how he's got this is sort of 87 there. I think what's the tagline there? New ways of valuing shares. Give some surprising answers. Yeah. There's a few comments there actually regarding Soros on there as well. But this is the thing, when you're sort of when the market sort of stays out of kilter for a long period of time, it goes away from the norm. Then you start making reasons as to why they are things have changed. So typically these things, when we it's different this time. It's the new economy. It's the new way of looking at things, a new way of valuing it. More money's lost, in the market from new ways of doing things or new ways of valuing companies than probably any other statement I've ever seen. So just have to be sort of careful there. The same things were being said in 87 here. The market's been obviously that kicked on a lot longer than everyone sort of thought as well. So this market has kicked on for a lot longer than everyone sort of thought as well. So just some context there. So interesting.
Well, very. We've got the benefit of hindsight to look back humorously, but obviously they were the cutting edge news and headlines at the time. And in whether it's 6 months, 6 years, or 26 years from now, we'll look back and no doubt we'll laugh at the headlines and things that we're looking at today. But,
I think we'll look back in about 3 or 4 years' time and look at some of the stuff that was been going on in the last 12 months and just shake our heads and goes, we think, crypto, meme stocks. Just some of the movements in the market, some of the behaviours, how many new accounts have been set up. It's just, there'll be books written about this period for sure.
Yeah, definitely. There's so many different, so many aspects of the market dynamic that have changed dramatically in the last couple of years.
Yeah.
But here we are, and we're grateful for you guiding us through. So thank you very much, Gary Glover from Novus Capital.
Thanks, Chris.